Okay, so in this video, I'm going to talk about how the market is not random. I'm going to talk about why context matters more than the setup, and why every trader needs an objective way to read the market. I'm not going to have a fancy PowerPoint for this one. I'm just going to go right into the charts and start talking about context and why it matters for your trade setups. So we're looking at a 1 hour chart of the micro E mini. This was back in March. Um, and you may look at this and find that there's a lot of noise going on here. And you can look at this and say, well, this is random. How do you know within each of these peaks and valleys in this trend that the market's going to reverse? And how can you make any sense of what's going on here? Now, there's something called the market cycle, and a very simplistic way of looking at the market. It's either doing one of two things. It is either trending or it's either consolidating. Now, you can take that core fundamental truth about price and begin to expand on it, because not every trend looks the same, and not every trading range trades within the same amount of points. Some trading ranges may only be 10 points wide. Sometimes it's 200 points wide. And so this is why context is important. And if you can understand the context, you can form a trade that has the right expectation for the trade. If the market is going sideways, it doesn't make much sense to trade it like a trend. However, many traders want a simple approach to trading. They want a one size fits all sort of strategy, or maybe they don't. But what I notice is that a lot of traders by default think this way and think that if I just buy off of this EMA bounce and I set a 2 to 1, that I will make money in the long run. Now, there's no guarantee that the market will continue to give you a profit if you continue taking that setup. I'm not saying you're going to win every trade, but I'm saying over the long run, there's no guarantee that that particular setup is going to continue making you a profit. There's no guarantee that it'll continue working on the next trade you take. Why is that? Because the market is always adapting, it's always changing. The environment is always changing. What I meant to say is the market's always changing, and your goal is to adapt. That is going to be your key to success, and that's going to be the quickest way to profitability, is your ability to adapt to the ever-changing market. The market's never going to be wrong. So quit trying to force your will upon the market. I could even pull up an EMA here, for example. I do use an EMA, and don't get me wrong, there's some things that I use that are subjective, but I don't ever trade off of these indicators or these levels as a reason to just take a trade. It's all about context at the end of the day. So I can put this in this EMA here. This is just a 20 period EMA. And if you were to buy a bounce on the EMA, let's just zoom in here and just say you were to buy this entry here. You see this big candle up, you buy at the close, thinking you're gonna get a breakout, whatever the case is. You first have to understand that this strategy is a trend following strategy. If the market is in a trading range, this approach is going to perform very poorly, because you're buying where the average is, the moving average is, right? It's a basically a mean reversion. And if the market is just going sideways, you're buying right in the middle of the trading range. If you want to profit in a trading range, you need to buy and sell the extremes of the trading range. You don't want to buy the middle. It's not a great trade, because if the market is in a trading range and it's going to the bottom of the trading range, chances are it's going to come back up to the top of the trading range. So you want to be buying low, selling high. Now, if the market is trending, then it's reasonable to think that buying at the average is a reasonable price, because the market is going up. So by default, this is no by no means a strategy that you should go and just start trading right now. No, you need to practice, you need to back test, you need to collect data. But what I can tell you is, if you were to take a trend trading strategy and trade that signal, no matter what the market condition is, you're going to do very, very poorly when the market starts to consolidate, because you're trading a trend trading strategy. So again, going back to my point, it's all about adapting to what's going on. So why did this trade not work? Well, if you zoom out, you can see that the market is actually in a downtrend. It's a very noisy downtrend. And here I'm going to draw some trend lines. And again, just because you draw a trend line doesn't mean you trade the level, right? You don't trade every time the market goes to the trend line. This is just to give you context of what the trend looks like. It doesn't need to be perfect either. It just, what's true here is that the market is forming lower highs and lower lows. And that's all you're trying to measure. You don't need to make it perfect trend line to make 2 points connect. You just need some sort of context here. Right? So you can take any strategy in the world. Doesn't matter. You have a lot of people in this industry saying ICT doesn't work and yada yada yada. This strategy is nonsense. You can make just about any strategy work with the right context. So for those ICT traders or those ICT people in that world, one thing that I will ask you, since it's quite relevant to the current state of the market, what I'm going to ask you is, how do you know what fair value gap is the one to trade off of? I think that's the $1 million question, right? Because you can look at a breakout. Let's zoom in here. What's going on? This breakout here. You can look at this. There's a fair value gap here. There's one right here. There's one right here. And for those that don't know what a fair value gap, you're probably like, what are you even talking about? That's besides the point. You see this big breakout here. There's a fair value gap here, which is reasonable. You took that trade, whatever. Anyways, the point I'm trying to make is, if you see a trend that is very wide like this, it's forming a very wide range. Let's see, there's about, from this low to this high. Wow, this is almost about 300 points. 300 point range, just about, roughly. Right? So if you see the market trading in this range, yes, it's trending down. It's a downtrend. So the edge is going to be in favor of the sellers. But would you want to take the very first fair value gap that forms? So right here you see the market traded to the trend line, and then it reversed. Obviously, this is going to be the best price you get in at, right? But we also have a fair value gap right here. Is this a good fair value gap to take? Not necessarily. Why? Because the market is trading within this trend, this context, this range. So you can even look right here. Is this a good fair value gap to trade? Look, you could have entered right there and got short. Well, not really, because remember the context of the trend. There's different kinds of trends. This is just a very wide trend, and I'll show you another trend in a second. But my point is to make you can make any strategy profitable with the right expectations, but it starts with one, your expectations and your ability to adapt and realize when it's time to take a trade and when it's maybe not time to, or maybe you can find a different reason to take a trade. You don't necessarily need to short here at this trend line. You can go long down here too. You can take these longs down here. If you see it trade within this, relative range of the trend line, well, you're near the bottom of the trend. And one can argue that it's not a bad entry to go long there. Now, as we evolve, you see we get to this point here, and this is really interesting. We get to the trend line again, and we attempt to break out, and this is naturally gonna happen. You're naturally gonna take losses trading. Can't avoid it. And I think this is a reasonable short to take. The market reverses here at the top of the trend line. You may go short right here, then you start seeing a bull breakout here. Now you're thinking this is maybe not a great short entry. This is you're starting to think of ways to manage your position here, and the market begins to consolidate here. Now again, back to the EMA strategy. If your strategy is to buy when price is above the EMA and it comes back down to the average and buy, well, this trade would have failed. Then it goes below it. Your strategy is, well, price is underneath the EMA, so I'm going to short when it revisits the EMA. Well, this trade was a loser. You can arguably get a trade here and get a very, I don't know, a scalp, I guess. You can get a scalp here. And yeah, some traders will say that that's reasonable. But my point, again, going back to the point, is this market is sideways. So if you were to trade a trend trading strategy in a sideways market, this is an example of how poorly it will perform. And here you would have really got chopped up here. But if you look at price, all it's doing is moving sideways. What is the direction here? Who has the edge in this range? Neither side, it's balanced. So what you can do is short the top of the range, buy back near the bottom of the range, buy the bottom of the range, sell it back at the top of the range. That's the most reasonable thing to do given this context. Then we have a big bull breakout. Now this is the start of a bull trend. You can now reasonably say the market is no longer trending down, right? We even put a higher low right here, right? And when we have this breakout, we at least have this context so far. We can connect these two lines. And what does this tell us? Like I said, this doesn't mean to buy when the market hits this trend line. You can definitely refine a strategy based on that. But what this is telling us is that the market is no longer forming lower lows. We're now putting in higher lows. Right? The market failed to go a swing lower. Instead, we broke out to the upside, and this confirms that the market's no longer in a bear trend. Now, it could either mean one of two things. It could mean that the market is now in a bull trend, or this evolves into some sort of trading range. But what we can rule out is that the market is not in a bear trend. Again, the market is now random. So if we can confirm that the market is not a bear trend, then we can start to rule out reasons to go short and start looking for reasons to go long. This is a very good reason to go long, if you ask me. Imagine if you just bought this candle here, the top of this candle. Yes, your stop loss would be down here. Okay, it's not great risk to reward, right? But say your stop loss was right here, you bought right here, and one can look at that and say, it's a very risky trade. Your stop loss is very far. Well, look at how much you would have made if you just held that trade And when the market reversed, where does the market reverse? It goes sideways here, but is that a reason to short? Not necessarily. The market is still in a bull trend. Is that a reason to exit? Maybe. I wouldn't think it's a great reason to exit, but some traders can look at that and say, well, the market's not trending up anymore, and that's true. So I'm going to get out. But there's still no sign that the sellers are flipping the trend. So I guess it's preference. It depends who you ask. But the market is going sideways here. And in fact, you get another swing higher. The market continues its trend. And when does it reverse? You can look at this and say, well, this is a reversal here. And yeah, that seems reasonable to me. Right? The market no longer puts in higher highs, right? You had this pattern of higher highs, higher lows. Again, it's not going to be perfect. Doesn't need to be perfect. But what's true is that the market is putting in higher highs and higher lows. When does it stop? It stops right here. Right? The market then begins to form lower highs, lower lows. So now you can begin to plan an exit here because the market's no longer trending up. Why would you be in a long position if the market is not going up? Makes no sense. So you can begin to plan an exit here. And you don't know, you truly don't know if this trend is going to continue lower and lower and lower. You don't know that it's going to continue to the upside. And that's the risk you take, right? For all you know, this can just continue trending lower. You don't know that it's going to happen. So it's safe to get out before it's too late, before you give back all of this profit when you entered down here. It's a pretty good trade if you ask me. And this is S&P minis, or sorry, S&P micros. Just one contract. This is let's see. You got in at about 6,800, and the exit was up here around 7,400. That's what? Having a brain fart right now. 600 points roughly. Good trade. What were you risking? Again, 6,800 roughly. You're risking a roughly 3 to 400. So it's like a 1-to-1 maybe. Doesn't look like it on chart. Maybe my math is wrong here. Let's just get a reference. Let's just say we exited right about here. It's 2.48 risk to reward. And again, I'm not pulling up a risk to reward chart before I took the trade. I'm looking at it after the fact because what I'm trying to focus on is being objective. The market is trending up. So if the market is trending up, I have no reason to exit my trade. Makes sense? Until I have evidence that the market is no longer trending up, what you have here. You can even argue, well, the market wasn't trending up right here, but was it trending down? No, there's not lower lows that form. There's no trend line that you can make out of this and say, well, that is a bear trend. Where? It doesn't make sense. It's a sideways market. And yeah, this bull trend lasted quite a while. And then we had a break in the trend. We started forming lower highs, lower lows. And what does that tell us? The same thing I said earlier. Give you a second to think about it, right? What is this telling us? It's telling us one of two things. The market is either going to start trending down, which is part of the risk, right, of being in a long position, or it's going to be going sideways, which it briefly did. But what it's not doing at this current time is trending up. So we can rule that off the table. And it did two of those things. You know, both of those scenarios were true. It did trend down, and it also did go sideways. It was a very brief period. That's why you see the trend resumed. But you see this is a downtrend. Right? Lower highs, lower lows. Then you get this breakout right here. It's telling us one of two things. The market is either going to be sideways or it's the start of a bull trend. But what it's not doing at this current time is trending down, right? So it breaks out and it goes sideways for a bit. Now, this whole thing is a trading range now. Let me keep that line there, actually. This whole thing is a trading range. And you see the sideways price action here. Kind of the market was trying to figure out, okay, is this going to be a trading range? Is this current state of the market going to evolve in a trader range? Or are we going to go higher? And the market had a tough time deciding that because it did form this higher high. And what is that? It's a sign of a bull trend. But it didn't form a higher low, it formed equal lows. So you can tell there was a slight balance in the market as the market's trying to figure out what is pricey and what is cheap, what's a discount and what's a premium, right? The market was trying to figure this out right here. You can see a lot of traders probably got mixed up there because some traders are viewing this as a bull trend, right? All the way up here. And yes, it is a bull trend. But also the people who are short, the bears, are trying to make sense and say, okay, well, we failed to put in a higher low right here. So this must be a trading range forming. Again, there's mixed signals, and that's usually the number one sign that you're in a trading range, when you can make reason to take both sides of the market. And reasonably so here. There is reason to take shorts up here and reasons to buy here. And in this case, the market quickly decided that this was too cheap and the market got bought up and then a bull trend formed. Trend resumed. However, this price action can be like this for extended periods of a time and just go sideways, However, in this case, we did get a bull trend and the cycle continues, right? Get this bull trend, and now we have reference of what this trend looks like. Look at this up here. I'm just trying to point out if there's any fair value gaps up here. You got a fair value gap right here. I think that's the only one. Let's see. You got one way at the bottom, right? Anyways, what difference does it make to buy this fair value gap compared to this fair value gap right here? You can see the market did go into that zone and didn't trend up, really. I mean, it went sideways. But why would you take this fair value gap? You're going long at the top of the trend. It's not a great area to go long. Better to take this fair value gap, this one down low, because this one's at the bottom of the trend. And we are using the context of the trend lines to tell us what kind of range this trend is forming. It wouldn't make sense to go long at the top of the trend line. It makes sense to go take a fair value gap down here at the bottom of the trend line when price revisits the trend line at a fair value gap. You're using the context of the trend, the higher highs and the higher lows that it's putting on. Again, it's not about the level. It's not about the trend line. It's not about where it is, because these things are subjective. Fair value gaps are subjective. Trend lines are subjective. But what's not subjective is that the market is trending within this range. That's true. You can't say, oh, well, the market is trending down here. No, it's not. It's trending up. I don't care how you try to, fit a square into a circle. You're not going to make it happen. Go ahead and try to short this. You're not going to get far. Where are the bears making money here? They're only making money on scalps or by dollar cost averaging in, which is risky, right? High probability, but very high risk. And most traders don't have enough capital to afford to take that kind of risk. So don't trade against the trend in this kind of scenario, in this trend. The market's going up. Then the market breaks the trend line right here, right? But if you bought this fair value gap, put a stop loss here at the bottom, yeah, you held through a little bit of noise, but eventually the market did break out higher. But yes, this is a trading range for sure. You could even say this is kind of a bear trend, even. Not so much. No, it is a trading range. And the market broke out higher, and buying here would have been a very good trade to take. Market continued higher. You would have got at least a 1-to-1. The market started going sideways here and say, oh, well, the market's not going up anymore. Maybe you exit right here. Well, you still would have had a winning trade. And then the market, you could even say that this is a trading range, right? So what's the strategy here now? Buy the lows, sell the highs. And once this formed into a trading range, you would have bought the lows right here, buy the thirds and sell the thirds. You would have bought the third here, sold the third here, enter short here, buy back the third here. So again, the market evolved into a trading range, and now your trend following strategy is no longer going to work in this scenario. You now have to adapt to the current state of the market. This is a trading range. So do not trade it like a trend, trade it like a trading range. Buy and sell the thirds. And you can just, if the market just went sideways all for, like I said, an extended period of time, you would make a lot of money just buying here, selling here, buying here, selling here. Stop loss at the low, stop losses at the high. You would almost win every trade because the market is not trending, right? So you're betting on the fact that the market will not break out. Eventually, the market broke out here, and then what do you look at? What do you say? What do you see when you see this? A bear trend. This is the start of a bear trend, and that's true. You see a strong bear breakout. You could short anywhere within these bars. Short right here, totally fine. All right, the market ended up trending down, and that trade would have been very profitable. Get your trend lines here. Lower highs and lower lows. So if you short it right here and say, well, the market's putting in these lower highs and lower lows, well, this is a very reasonable exit right here, right? Because you're exiting at a trend line. You see that this is a bear trend. You're exiting when the market is at the low of the range. So if you enter here and exit right here, it's a very good trade. Then the market breaks out higher. And what do we know is what do we know now that is true? The market's no longer in a downtrend. You have higher highs, higher lows. Again, the market is not random. That's the whole point I'm trying to make. Okay. What did I say at the beginning of the video? The market is not random, and I'm trying to show you how it's not random. I'm trying to explain why context matters more than the setup. And we can sit here all day and pull up all these different kinds of indicators and try to figure out a strategy that fits for all we could combine them all and say, okay, maybe this is the holy grail here. It's not going to happen because you need the context. And this is why, as I mentioned, context matters more than the setup. And lastly, every trader needs an objective way to read the market. You can only get so far by being subjective. You can only get so far by using a fair value gap for every setup, using a trend line for every setup, using an EMA for every setup. You can only get so far by doing that. You won't get far by doing that. You need an objective way to look at the market. That way, when you look at it, you're not questioning what's going on. You're not thinking, well, I don't know, is the market trending up right here? That's a terrible place to be in. It's a terrible state of mind to be in as a trader, is to be uncertain. There's already enough uncertainty given the variance of trading. Now, if you don't know what you're doing, you have no certainty, no confidence in your strategy, how on earth are you going to make money doing this? And so it should get to the point where you know, again, going back to being objective, right? Your trading should get to the point where you know that either you made a mistake because you failed to follow the rules of your strategy, or you lost the trade, or you lost a trade due to the normal occurrence of a trade losing, and there's no rhyme or reason to it, right? You lost a trade, you stuck to your plan, you stuck to your rules, and naturally you're gonna take losses because you can't win every trade, right? You might see this market trending down, you might enter short right here, or you enter short maybe right here and say, well, this is a reasonable trade. The market's trending down. That's true. That's objective. But when the market goes up and you lose a trade, was it because it was a trading error? Was it a mental mistake? Was it a behavioral mistake? No, this is just a normal loss because the market is going to change. The market changes. So once you see this, you don't cry and you don't sit back and say, well, I suck at trading. No, you then look at what the market's doing now. You stay objective. You say, well, the market's not going down anymore. Market's going up. So I can't short this now. Don't try to short to get your money back, thinking that you know better, thinking that you figured it out, and I think the market's going to go down. I know it. No, 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 no. The market's not going down right now. The market's going up. So don't try to short because you are trying to revenge trade and you think you know more. It must go down eventually. It's not the right place to be in. You want to have a object. You want to have an object. You want to have an objective way to look at the market. That way, you know when you take a loss, you know that it was either a behavioral mistake that you failed to follow rules, or it was just a normal loss that's going to happen. And when you take losses based on following rules, it feels much different than if you take a loss because you broke rules. When you take losses when you break rules, it hurts a lot more because you knew it could have been prevented. But you failed to follow the rules, you failed to maintain your discipline, and it could have been avoided. When you follow your plan and you take a loss, it doesn't feel so bad because, and I'm not saying, you need to test your strategy as well. You need to practice these things. You need to demo trade. You need to back test. You need to journal every single day. Trading is not just buying and selling and I think the market's going to go up today, so I buy. No, 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 no. Trading is every single day. Not only are you trading, that's the easy part. You need to set your analysis for the day, right? You need to prepare to take trades. Then, of course, you execute your trades. That's the easy part. Then you journal your trades, all the trades you took in that session. Then you go back and look at the session and say, okay, is there anything I missed? Could I have taken a different trade? Why did this trade lose? In hindsight, you can always tell in hindsight, right? Oh, I took this trade here as a short, but the market broke out of the trend line, like I said right here. You were short here, and that was reasonable to take the trade. But then you see why it lost after the fact, and you see, oh, the market trended up here. And you do this, and this process begins to, you start to notice things, and you start to journal these things, and then you start to develop a strategy out of these things. And this is how you develop an objective way to look at the market. Like I said, if you don't have a structured plan and you're not objective what you're doing, you're going to take this loss right here and the market's going to start trending up and you're going to start thinking, nah, man, the market's going to go down eventually. I know it, if the market's too pricey. But that's not objective, right? Because the market's not going down. Anyways, there's a lot we can cover on this topic. This is sort of just an introduction. If you want to connect with me, I'll drop a Discord link in the description. Totally free. It's really just a network and to talk to someone that actually knows how to trade, understands the market. And so if you feel you're a bit lost in that, feel free to reach out. And if not, you don't have to be in that stage in your trading either. If you just want to connect, just hit me up on the Discord. I got a few people in there already, and we chat here and there. But I'm definitely trying to build a community and help traders get to where they want to be, completely free. There's no, again, I make my money from trading. Okay, so I don't need to sell a course to say, oh, okay, I need to make some money. I don't need all that. I'm just there to network, talk to people, talk to other traders. This is what I like to do. So hit me up if you have questions. If not, if you don't have any questions, hit me up still and we can chat. Anyways, that'll wrap up this video here. I'll catch you on the next one.